In this video, I am going to share 6 factors to be considered while availing a loan from banks or financial institutions or any other person. Hi, my name is Jithendra Patel and I am on a mission to help entrepreneurs with financial advice to build a profitable business. Factor number 1. Be clear for the purpose of loan. The purpose of taking the loan should be clear, whether it is for buying plant and machinery, construction of building, or for working capital needs. Once the need is identified, use the funds for that purpose only. Many business owners sometimes take loan for working capital needs and buy land with it, which can cause stress on the cash flow of the business, as the land does not generate any income in the short run. On the other hand, the interest on the cash credit limit must be paid every month. It has been alleged that the Rotomac pen owners, the pen that many of us have used, have availed loan in the parent company and used in the business development of the other group companies, which ultimately collapsed, resulting in the collapse of as a group as a whole. The reason is not using the loan for the purpose which it was availed. Further, the loan availed should not be used to earn higher interest by lending it to someone else if lending is not your core business, as downfall in their business will affect your business massively. Factor number 2. Return on investment to be more than interest paid. The rate at which the business will earn as per the business plan should be much more than the rate of interest on which the term loan has been charged by the bank. That means if the rate of interest charged by the bank is 12%, then the business should be able to generate about 30% with the use of this money for the purpose of business. If this is not the case, then the business should not go for the loan. Factor number 3. Debt equity ratio should be 2:1. The debt equity ratio is used to evaluate a company's financial leverage, and it is calculated by dividing a company's total liabilities by its shareholders' equity. Debt equity ratio is an important metric in corporate finance. It is a measure of the degree to which a company is financing its operation with the debt rather than its own resources. Among similar companies, a higher debt equity ratio suggests more risk, while a particularly low one suggests that a business is not taking advantage of debt, financing it to expand. An ideal ratio of 2 times of debt for every 1 equity contributed is considered good. If the loan amount exceeds the twice of the equity, then the business owner should refrain from accepting of any other further loan. Factor number 4. Discipline in managing finance. The business owner should go for the business loan only if he is disciplined in managing finance. Like the trade receivables have to be collected on time. The business model has to be profitable. The MIS has to be checked regularly. It may so happen that the cash flow might be struck up with the debtors. There might be non-moving inventory. In this scenario of long cash conversion cycle, the loan will be going on the servicing the debtors and the inventory. If the business owner is not disciplined, then the loan fund will come and go, but the business owner problems will remain the same. Further, the business owner may also have to take a new loan to clear up the existing loan. Factor number 5. Total debt to assets should be less than 0.5. This ratio is equally important like the debt equity ratio. If a company has a total debt to total business asset ratio of 0.4, it means that 40% of assets are financed by the creditors and 60% are financed by the owner. The total debts divided by total asset should be less than 0.5. That means your debt should be less than 50% of your total assets. This will enable to create a balance into the business even if your business go haywire. There are assets to help in repayment of loan. Factor number 6. Use the funds for what it was taken. When we take bank finance credit limit, the same needs to be used for the working capital needs of the company. If the same is used for buying property, then it is a clear violation of financial discipline that short-term finance is used for long-term purpose. This may create undue stress on the working capital of the company. So these are the 6 factors to be considered while availing loan for your business. If you find this content useful, do share it with your friends. Do like and subscribe to my channel. This is CA Jithendra Patel signing out. See you in my next video.